We have some new data that suggests a recession might very well be upon us. I'll show you that in just a minute. But first, remind you that a couple of weeks ago, I shared a video that talked a little bit about the fact that February is historically the second worst month in the stock market, but no worries, March is historically much better. I also talked about the fact that none of these things are guaranteed to happen. Yes, the first year of a presidential term is historically good. That doesn't mean this year is going to be good as it relates to the stock market. We also talked about some of the reasons why we might want to be concerned. And now we have a new reason. After President Trump and President Zelensky's meeting last Friday, there's certainly more reasons to be concerned about that war and what that impact is to us here in this country and our economy. But in addition to all of that, we now have fresh data from the Atlanta Federal Reserve. Their GDP Now tool is forecasting negative 2.8% GDP for the first quarter of the year. Now, you'll recall that historically speaking, the National Bureau of Economic Research declares a recession once we see 2 consecutive quarters of negative GDP. Now, there's some debate about that because back in 2000, I think it was 21, they did not declare a recession, even though we did see minor contraction in GDP 2 quarters in a row. Negative 2.8 is a lot more than what we saw in terms of contraction back in 2021. So this is definitely a bit alarming, as well as the steep descent on their GDP Now tool. In addition to that, we can also look at the 10-year yield. What I'm trying to show here is that this 10-year yield has been in a sideways channel for the last couple of years, but recently it has been coming back down. Now, the Federal Reserve's most recent meeting notes that I have reviewed from the Federal Reserve suggest that they believe the federal funds rate might be down to 3.4% by the end of this year. Well, that would imply the 10-year yield also coming in. And so the argument is the 10-year yield, the fact that it's coming in is also suggesting a bit of a recession. One more point, and I'll talk about investments. This is from the Chicago Federal Reserve. This is their financial conditions sub-index. And usually what you see is this rises above the zero line as we're going into recession. And the most recent data suggests this is still not recessionary. So there are reasons to be concerned about a recession. From a financial planning standpoint, it doesn't really change. We would encourage you to make sure that you're paying off debt, especially the variable rate debt. Make sure you have cash reserves, etc. But a lot of people are worried about the economy because it impacts their stock portfolio. Well, as we've discussed multiple times, our belief, our strong conviction is that nobody can know definitively what's going to happen in the economy. Nobody knows definitively what's going to happen. Therefore, since the cost to making changes in one's investment portfolio is practically zero, there's an argument now more than ever before, in my opinion, about active portfolio management. So we believe in remaining tactical, even though we believe the market might very well have a decent year this year, even though that is our conviction, even though that is our bias. If the market is selling off, we're going to follow our investment management rules and take action. We use a multi-strategy investment approach and when managing money for our clients. In general, we have 2 quant models and we have 2 tactical models. And so our tactical models tend to raise cash very, very quickly versus our quant models are rules-based, although they might also be raising cash. If you have any questions, by all means, feel free to reach out. We are strong believers that active portfolio management, well, active means active. And managing a portfolio successfully over a long time it just comes down to managing math, keeping your losses small and recognizing that no man, no woman knows what's going to happen. Again, let us know if you have any questions.